Hey everyone, welcome to your Algo Lab. In our last episode, we explored the 10-month resampled moving average strategy on global equity indices. If you haven't watched it yet, we highly recommend checking it out. The links to the previous episodes are in the description below. Today, we'll delve deeper into some optimization techniques. There are many advanced optimization techniques available. In this episode, we'll use one called grid search. As the name suggests, grid search is an exhaustive search technique used to systematically tune the parameters of a strategy. To illustrate, let's suppose we have a strategy with two parameters. We define our evaluation metric, which could be return, risk-adjusted return, or any other metric. In this example, let's suppose that we have the risk-adjusted return, where a higher value is better. We observe that the combination of parameters 3 and 30 yields the best result. Ideally, we aim for a pattern where the optimal combination is located within a zone of stability. This is important because we want our best parameter set to be robust, meaning that small changes in the parameters should still result in good performance. Returning to our resampled moving average strategy, we have already implemented our benchmark buy and hold strategy and the 10-month resampled moving average strategy. Here we focus on their annualized returns, highlighting where our strategy outperformed the benchmark for clarity. For our 10-month resampled moving average strategy, we have only one parameter to consider, the moving average window. Instead of using a grid with multiple rows and columns, we will concentrate on a single row, testing both shorter and longer time frames. In terms of grid search, we'll select a few specific time frames rather than conducting an exhaustive search. For long-term strategies, our objective is to find commonalities between similar assets rather than pinpointing a specific parameter to maximize individual risk-adjusted returns. We use different backtesting methods for short-term and medium-term strategies, which we will discuss in future episodes. We'll select two parameters 6-month and 8-month, which are below the 10-month moving average, and two parameters 12 and 14, which are above it. We'll run the complete program using these parameters and evaluate the results based on absolute return, maximum drawdown, and risk-adjusted return. Let's begin by examining the returns. We observe that all the parameters exhibit relatively similar returns. These returns fall below the benchmark buy and hold strategy, but surpass those of the long-term daily moving average that we backtested in episode 1 to 3. In terms of the number of outperformances, the resampled moving average also scores better. The monthly resampled moving average shows a 27% outperformance rate compared to 16% for the daily moving average. When considering risk or maximum drawdown, all monthly resampled moving average strategies outperform the benchmark. Now we present the risk-adjusted return calculated as the annualized absolute return divided by the maximum drawdown. Here we observe that all the monthly resampled moving average strategies exhibit a better risk-adjusted profile compared to the benchmark. In terms of the number of outperformances, the resampled moving average also scores better. The monthly resampled moving average shows a 74% outperformance rate compared to 50% for the daily moving average. Let's take a closer look at some of the best performing strategies in terms of risk-adjusted return, starting with the 10-month resampled moving average strategy on the Nasdaq. At first glance, the number of small losing trades has significantly decreased. In fact, compared to the 200-day moving average, the win rate has improved from 22% to 55%. Additionally, the number of trades per year has decreased from 3.5 to 0.8. For long-term indicators, a lower number of trades per year is preferable. The strategy performed well in avoiding large drawdowns, particularly during events like the dot-com bubble. Notably, thanks to the filtering mechanism of the resampled moving average, the strategy successfully avoided numerous false signals during bear market rebounds. Now let's examine some of the worst performing ones. We look at the Seng index with a 10-month resampled moving average. The strategy performed reasonably well until 2010, but from that point onward, the number of losing signals exceeded the winning ones. This shift is largely due to the Seng index entering a prolonged volatile and trendless market after 2010, where a trend-following system is less effective. To wrap it up, today we ran a grid search on our long-term resampled moving average strategies across all global equity indices. While the strategy didn't enhance absolute returns, it did improve risk-adjusted returns. Additionally, we found that the results generally outperformed those of daily moving average strategies. In the next episode, we will backtest the resampled moving average strategy on other asset classes, including fixed income, commodities, currencies, and cryptos. Be sure to check out our other videos. If you're enjoying the content, don't forget to like, subscribe, and hit the bell icon so you never miss an update. Thanks for watching, and I'll see you in the next one.